once we get into the market at that 10,148, as I mentioned, we want to make sure we have a stop at 100 points. We're being, we don't want to get rid of our profit if we possibly can. We want to keep moving that up a little bit. So we're only going to use a 100-point, stop below where we entered the market. So that stop is going to be at 10,048. That puts the stop in this, again, somewhere right in there. As you can see, once we got in the market, it did not come back to there, no threat for that. And so the market then was able to move up from there. But as the market moved up, we start to change our thinking about where we're going to put that stop. And one of the things we use is the predicted low. In this particular case, we had a predicted low on this date at 10,303. So our 10,303 minus 10,000 or minus 200 leaves it at 10,103. So we can move it up there because we can then adjust our stop. Remember, we were at 10,048 before, so now it's 10,103. We try to keep our risk, as limited as we possibly can, so that we don't get stopped out prematurely, but also so we don't let the market run until the point that we get into a big loss. So we have moved it up a little bit. It was a threat on February, and this February decline right here that, on February 25th, looked like we could have gotten knocked out, but our stop barely held. That's why you don't want to have them too close, because you do want to be in a position for the longer move if it does occur. As you move forward here, it is possible that if you were in a situation where, again, depending upon your risk and depending upon the size of your account and those kinds of things, where you could take an add-on position. There are several ways you can trade this. You can have profit targets. You can add on to your position. I like to, if possible, get multi-contract positions simply because that gives me a chance, some flexibility if the market turns, that I can get out of some of it with a profit. And if it, then does turn, I haven't lost everything. I have something to show for my effort, and I've gained it. On the March the 1st, this day right here, we had a predicted high of 10,368. So that means that we would be buying at 10,568. Again, as before, it does take a little while to get there because the market kind of waffles sideways. Again, that order sits there, waits there, and it then becomes active at 10,568, somewhere right in here, about a week or so later. And we then would have a second contract that we could potentially ride an up move. Of course, you're going through the same risk analysis study that you're going to have. You're going to have your stop at 10,468. You're going to keep moving your stops up. In this particular case, where you had your stop somewhere in this vicinity, right here, let's say, but you're going to keep moving it up. As that predicted low moves up, you're going to keep your stop 200 points below that predicted low, and when it gets up high enough, of course, it is going to be higher than the initial stop, and you're going to be moving that stop up as you go, simply because the more that you can prevent yourself from getting into a loss situation, the better off you'll be. Let's go back now and take another look and talk about the second half of this period that we were talking about, the chart that we showed you on the screen initially, and kind of decipher a little bit about what will happen with the more current situation that we are now in. First of all, we have to change our custom settings. We're going to change this one. We're going to go all the way back up here to our current date, and then we're going to back off from there. We're going to say that's okay, and then we're going to back off from there and say we want a 3-month chart. Okay, that puts us in the situation where we, where the tide starts to turn. When you look at this chart, you can see that, the trend from the previous chart, it shows where the trend continued to the upside. As I mentioned, it was a 3-month uptrend, kind of a gradually, steadily higher, even though everybody said, well, it can't go higher because there's so many negative things going on that the market just can't possibly go higher. Unfortunately, I shouldn't say unfortunately, I said fortunately, it just kept going higher and higher. But there came a time when, as is the case in most markets, where things start to change, and that tide started to turn in this particular time period in in late April, and then it was just a matter of trying to gauge, at what point is this market going to turn? At what point would we take those profits that we had on those other contracts? Kind of what actions are we going to take? We'll go to April 27th. We'll see right here we had a situation on this particular candle, this long black candle, which in and of itself, one candle is kind of a bearish situation. I mentioned earlier we had the doji here right before that. A couple of things that came together that suggested that and we already know that we had the situation with the predicted differences. We're starting to edge down. So not everything was as bullish and rosy as it was before, but on April 27th, the predicted low that particular day was 11,093. When I say the predicted low, that was the highest predicted low that we had, and that is what we're going to use kind of as our gauge as to where we're going to put our stop to take our profit. So we would put that stop in at 10,893, which is 200 points below that predicted low. Now, it does take a little bit of time for that to occur. It doesn't happen until we get over here, all the way over here to May the 4th. And that predicted low comes in at 10,893. And we're in here, again, kind of a rough estimate of where that is. Now, if you remember, we had a initial position that we got in at 10,148. And a second position, if you did an add-on type of a strategy, on March the 1st at 10,568. So you put together the profit that you made from that move up to 10,893, and you have more than $5,300 in profit on that long position that you now, after these few months, have been stopped out of. So not too bad a trade for a one mini Dow contract. You might have multiples, and so there are some other types of things you can do to increase it, but we're just looking at it just as in our example here of how to handle a strategy using just the one contract. Now, I mentioned on this May 4th date here, we had a situation here where the predicted low, 11,041, which was below this predicted low that we had earlier. Remember, we got out based on the low at this particular point right here, the stop below this predicted low because it was higher. But we now can use the predicted low that we have on this particular candle for this particular day as a potential place to enter the market short. Knowing, again, as you look down at the predicted difference, they're pointed down. We have the Neuro Index now in this area at 0, so that's bearish. That means that the price is going lower in the next couple of days. You have the probably the best clue, longer-term clue, is you have the predicted moving average. That blue line is now below the black line, and you like to be on the side of the wherever that predicted moving average is to the actual moving average. You like to be